From the Sunshine State, this is Tampa Bay's Tan Talk.
It's time for FLALAW, brought to you by the personal injury attorneys of Paranick, Caulfield, Averill, and Noyes. This hour will be informative, along with taking your questions and comments. Now, here are your hosts for today's show.
That's right. We are back with FLALAW live on the radio. Thank you for coming back and joining us once again with your live legal call-in talk show. Hopefully you are our faithful listeners and you know that we are here every Tuesday at 5 o'clock to take your legal questions live on the air. We're excited once again to be back this week with another show for you guys. And we have a great guest tonight who has been a frequent flyer, if you will. She's been quite a wonderful co-host, giving us so much information on taxes and tax law. So I'm excited to have attorney Alena Miles back with us again. And it's very timely because we know last week was the tax deadline that so many people had to get those taxes in by April 15th. Well, we're here to have her in because we feel like this can be a trying time for people because they're either having to ask for extensions or maybe they're a little late or they're uncertain about the document that they just filed and they have some questions or concerns. And this time period can bring up a lot of issues and questions and things can come down the line like that scary word audit. So this is where Alena shines. She is here to answer your questions and be able to basically inform you on some of the things that might be concerning during this time of year. So we've got a couple great topics for you tonight that we're going to go over as it pertains to taxes and tax law. And so before we do that, I am going to, of course, give you all the information and details to let you know how to continue to tune into the broadcast for the full hour. This is an hour-long show, and you do have that opportunity to call in during this time frame. But of course, you may step out of the car. You can't listen on the radio, or if you have to step away and you want to be able to listen later, all those things are covered. So let me tell you about it and how we're going to be broadcasting tonight. First and foremost, you can tune in obviously through the radio at WTAN 106.1 FM and AM 1340. So that's the way to get us on the radio. We are live in the studio here at WTAN. So that's going to be your best option in the car and on the radio. With that being said, if you are in front of your your computer screen, maybe you're on your phone or your laptop, you're still at work, and you want to watch the live stream and see me and my lovely guests, then you can definitely do that on our Paranick, Caulfield, Averill, and Noyes pages for streaming. We have Facebook and YouTube's live streaming right now. I'm actually going to go ahead and share that broadcast out so that if you're looking for it and we're friends on Facebook, then you can go to my page and you'll see that I just shared it. Hopefully you can share this with someone as well, especially if you know someone that may have some tax issues that they have an issue about and they want to get some information tonight or have a question. This is the show that you want to share with them. So go ahead and share it, like, comment, let us know so that they can tune in to our guest tonight, Attorney Alena Miles. If you don't have Facebook, we're also on YouTube. The spelling is PERENICH. Type in Paranick. You should be able to find Paranick, Caulfield, Averill, Noyes Injury Lawyers. That will take us to the page that we're streaming on right now on YouTube and Facebook. And you can comment in this section. So if you don't want to call in, that's okay. You can comment in the comment section and we will read those out over the air for you. And Attorney Miles is great at tackling those questions as they come in. And of course, if you stay on while we're live, and you can obviously follow up if she has more insight for you, and you can follow up that way. If you'd rather do it in the comment section, not a problem. However, if you're brave enough, we want to hear from you on the phone, so you can certainly call in. The call-in number is 727-441-3000. That is going to be the number that you dial to call into the studio and have your question answered or asked live over the air. Again, that's 727-441-3000. The lines are open. And I am going to turn it over to Attorney Miles just to briefly introduce herself again. Like I said, she is a frequent guest of ours. We love having her on the show. So if you are a faithful listener, then you already know who she is and what she does. But for those that may be new, if this is your first time tuning in, or you specially tuned in just because of the tax topic, then I'm going to let Attorney Miles tell you a little bit more about herself, what she does, and where she practices.
Yes, thank you, Jaclyn.
Absolutely.
I'm glad to be here. Yes, my name is Alena Miles. I'm a tax lawyer and I'm dual licensed. I'm also a CPA. My headquarters are located in Safety Harbor, but I do have by appointment locations in Lakewood Ranch, Venice now, Miami, and the Keys. The area of law I practice is tax, and I deal with clients that have primarily problems with the IRS, like they owe large tax debt, where interest and penalties, for example, are accrued. And that number can grow fast. Penalty notices, so anything IRS related. Also, I do international tax, where, for example, the house that is being sold in Safety Harbor is owned by a foreign person.
Mm-hmm.
So international tax named FERPTA would be triggered. And another area is Florida sales tax, where people get audited by Florida Department of Revenue, and they need representation. So those are my primary areas of focus.
Okay, perfect. So for those of you who are tuning in and have some tax questions, then you have an expert on the line tonight. It is something that I know nothing about, but that's okay because I've brought in someone who does. And we do have every now and then a little lull for questions of injury related. So I can't answer those questions if they come in tonight. But obviously the main topic for discussion is going to be taxes. So before we jump into this big case that I know you wanted to discuss, the Kwong versus United States case,
Yes.
I do want to just circle back to something I teased in the very beginning, which is obviously I know some people probably feel relieved. They just got their taxes done, but maybe they're not 100% confident or still a little bit of uncertainty about what they should be doing in the coming weeks. If there's any opportunity coming up where people could maybe have more problems coming, or maybe they could save money, is there anything that people should be thinking about right now?
Definitely. That's a very good question, Jaclyn. I was going to hit on that myself too.
Perfect.
May 1st is the due date to file a Florida corporate income tax return named F1120. Do not miss that deadline, okay? That doesn't apply to everybody. And as a matter of fact, we do not have personal state income tax in Florida.
Right. Mm-hmm.
That's why Florida is appealing to snowbirds and all that, because northern states, for example, have state income tax. We do not. However, we do have Florida sales tax, and we also have Florida corporate income tax.
Right.
So if you're like 1120C corporation, you might be subject to Florida corporate income tax. Okay. And that return is due in May. So now we're at the end of April. Do not forget that if you are that 1120C, and you're a Florida corporation, you need to think about that return due date. People ask, what do I do if I didn't file my taxes on time? Am I too late? What do I do? The longer you wait, the worse it is for you. So jump on it right away.
Yes. Yeah. You've said that many times before. Delaying is not the answer when it comes to your taxes. And I'm sure we'll touch on it here and there tonight about why that's not a good idea. But what about extensions? Can people file extensions, or is it too late for that too?
S Corp and partnership extensions were due March 15th. So it's too late for those.
Okay.
Individual income tax, federal income tax, and corporate income tax, federal side, will due April 15th. So it's too late to file that extension. But if you missed it, it's not the end of the world. You just want to catch up with it sooner rather than later.
I gotcha. So if you were going to ask for an extension, it had to be before the April 15th deadline.
Yeah. Okay. And from the business side of things as well, if you have a Florida LLC, there is annual report that you have to file. And if you do not file it by, I believe, May 1st, you're going to be assessed extra, I believe, $400. So if you have multiple LLCs in Florida, do not miss this due date because it could be costly.
Yeah, absolutely. So is that what you were talking about with the 1120 or the 1120C?
No,
Is
that's
that something
separate.
different?
That's
Okay.
separate. Yeah, this is on Sunbiz. When you go to create an LLC, on Sunbiz there is a registry of your LLC.
Mhm.
So on Sunbiz you're supposed to renew your annual report every
Yes,
year.
yes.
Okay, so if you haven't post, I believe May 1st, the rate goes up. So you just have to pay way more. So you
Okay.
don't want to miss that due date.
Gotcha. So this is a time frame where there are still some deadlines that have not come up yet, but you don't want to miss those because, as you can see, the deadlines for extensions and filings pass, and then there's not much you can do after they pass other than just to get it done.
Correct.
Because then the penalties begin, right?
The penalties and interest. So if you do owe tax, in addition to penalties, there is failure to file, failure to pay. But if you do owe tax, there is also interest, and the interest number could be huge on its own.
Now, I've heard for people that don't owe, that are expecting refunds, that there is no true deadline. Is that right, or is that not really true?
That's okay. So 2 points there, and I think I hit on it before. But one point is that if you never file your tax return, and let's say you think you're in a refund overpayment position, okay? The clock, the statute of limitation never starts ticking. In other words, they can go back and audit whatever year is open. That's 1 point to file your tax. You want to file your tax return. Second point is you're on a time limit. So if you're in the overpayment position and you wait too long, you might lose your refund.
Really?
Yeah.
You could forfeit your refund for waiting too long.
Yeah.
Is there a time frame for what constitutes as
typically,
too long?
Yeah.
What
typically,
what does that mean?
Typically, it's more complicated. I'm going to simplify it, but typically it's 3 years.
3 years. Yeah. Okay. I mean, if you are due a refund, I don't see why you would delay that long to get what you're entitled to. But I guess that's very good to know. Don't wait too long.
Don't wait too long.
Don't think that, oh, I don't owe anything, I'll get around to it, because you could then lose what you might have been entitled to come back to you. Yeah. All right, good. So there's this case that you had mentioned to me, and I wanted you to talk to our listeners about it, the Kwong case. So is there still a major deadline coming up? And if so, what is the Kwong case and why is it such a big deal?
So everybody in the tax legal community right now is talking about this case. Okay.
So that's why I don't know anything about it.
This is hot topic for tax people.
All right.
For tax nerds.
Listen up, folks.
But ultimately, you potentially have until July 10th, 2026 to ask the IRS for penalty and potentially interest abatement if you had tax setbacks during COVID era tax years, such as
going way back that far.
Going way back, such as 2021. There is a certain window of opportunity, but roughly, to simplify, roughly 2021 tax year through 2023.
Really?
So if you miss the July 10th due date, then you lose that chance. So this is a chance.
So it's a very big deadline.
Yeah. And that applies to people who already paid penalties and interest, as well as those that were assessed but never paid it. So if you paid it, you potentially can get your money back.
I was going to ask that. So you said you're getting an abatement. So an abatement could essentially turn into a refund?
It can turn to a refund if you paid it. If you didn't pay it, but you were assessed penalties and interest, you just get a write-off of your balance, potentially. Right.
And that is July 10th.
July 10th. So if you have...
Who does this apply to? Is it just business owners? Is it individuals? Yeah, is it both? Or?
Both. And because like if you have, let's say, an S-Corp tax tax return, S-Corp doesn't pay tax. It flows through to the owner. But the owner's return depends on the S-Corp's tax, the income and all that. So ultimately, technically, it's going to apply to the ultimate owner in my example, which is the individual. But it doesn't only, I believe, it doesn't only cover income tax. It also covers payroll tax. There are other opportunities there. So.
Well, tell me about that, because of course, I don't want to put you on the spot and ask you to brief the entire Kwong case for me. But just so our listeners, so that they can try to appreciate whether this applies to them or not. What exactly would qualify you for these COVID era abatements? Is it something that you can say that might say, oh, that might be me. I pay penalties during that year. Is it just because you pay penalties and interest during that time, or is there a certain qualification?
Yeah, so we can break it down in baby steps, right? Okay. So ultimately, what it says is that why do you get to use this quant case? You potentially get to use it because during the COVID times, certain due dates were put on hold.
Right.
So that gives people a little more time. Okay. So the biggest point is that the interest, for example, a penalty for that period should have been paused. But it hasn't been paused.
Right.
It kept growing.
So now the court is going back and correcting that.
Basically, you can say it like that. And this case can get appealed. But as we stand today, this is a big opportunity. Everybody's talking about this opportunity where, once again, if you are, let's pick on like a theoretical, simple example. Let's say Joe is a sole proprietor. Okay. And Joe has a small business. He doesn't file S Corp. He just files his taxes through his Schedule C. Let's simplify things.
Right.
Which is a part of his individual tax filings.
Right.
So he doesn't have anything separate. Let's say it's just one big filing. Okay. And Joe owed tax for 2021, 2022, and 2023. And he fell behind. He didn't know what to do because there was COVID. People didn't know what was going on back in those years. People were scared. And so he had other priorities and, he fell behind, unfortunately, on his taxes. Okay. So tax is tax. You cannot abate tax. That's not what we're talking about here. We're talking about interest and penalties.
The penalties and the interest that accrued. Okay.
Only through that short window of opportunity, not like post that. So it has to be fixed, the fixed months that you would have to look at. But ultimately, in my example, Joe can, if he paid his tax, if he paid his interest, and if he had paid his penalties, he can ask. That doesn't mean he's going to get granted it right away. It doesn't mean it's going to be easy. But before July 10th, he can preserve his right to ask for interest, for example, the penalties that grew during that window, which is certain months of 2021 through 2023. If Joe never paid his tax, let's say right now it's 2026, but Joe is still behind, okay? Yeah. So, but Joe got assessed penalties and interest, and he can still ask for that abatement. Once again, this is an opportunity.
Right. Absolutely. So this is basically, and please correct me if I'm paraphrasing this incorrectly, but this is basically an opportunity for folks who may have fallen behind during those COVID months or years and could have filed late or whatever the case may be. They accrued penalties and interest. Yeah. And this is the kind of case that might help them.
Exactly.
Got it. Okay. So then you mentioned that it's an opportunity and they should ask. But how do they ask? What's the process between now and July 10th?
So the funny thing is that some people, and I see that happening where taxpayers try to take their case to whatever level they can. They make all sorts of mistakes and then they run to me or somebody,
of course,
another tax attorney.
Of course. Yeah.
But for example, what you look at is I saw beautiful letters that taxpayers wrote to the IRS explaining why this shouldn't have happened, why this was a mistake, such and such. But ultimately, there is the correct procedural way to ask for abatement, and it's not just writing a letter. Okay, there are special forms that have to be filed to preserve your right. Let's say if we pick on the Quan case.
Right.
So if you don't follow the steps, if you write beautiful letters to the IRS explaining that you deserve that right, I don't think that's going to work. Yeah.
What exactly, and obviously not to take too much time on it, but what exactly would it be then if it's not a letter? Is it some more formal document?
It's a formal document. Okay. There is a separate form that you would want to file, and it's put in the information correctly in to ask for penalty and interest abatement.
Okay.
It's not just a letter.
All right, perfect. That makes good sense. So then I want to know what we're looking at in terms of payroll taxes. So I know that this is also the season for that sort of thing.
Yeah.
So we have this situation that we see sometimes when it comes to payroll tax theft, right? So let's shift to something like that, because to me that sounds pretty serious. But I don't know if sometimes it can be inadvertent rather than intentional. But what do people need to know? What exactly is payroll tax theft?
Yeah, so payroll tax is much more serious, I think, than income tax. If you fall behind on payroll tax, it's theft of tax. And I'll explain in a second. But if income tax, it's your tax that you owe to the government. Okay, payroll tax is not your tax. So if I'm your employer, Jaclyn, and I take payroll tax out of your paycheck, okay, I'm supposed to send it in full within a certain amount of days to the IRS. If I do not do that, if I collect your payroll tax and I'm using your money, no, actually, it's not your money, it's the government's money at that point, I'm stealing payroll tax. I'm using it, misusing it for my purposes.
The money that was withheld from the employees' paychecks.
Yeah.
Okay.
And that number could be huge. So it's called trust fund tax, the tax that were withheld from the employees' paychecks, that piece, because employer has to match.
Yeah.
So that's not trust fund piece. But whatever was withheld from people, from employees, is trust fund piece. That is the sensitive part.
Right.
Okay. And the enforcement and aggressive enforcement and all that against payroll tax, it is what it is. It's theft of tax.
Interesting. So is this something that small business owners who may not be as savvy as larger corporations, is that something they can kind of accidentally fall into? Because the way you're describing it, it seems kind of intentional if you're taking the money and doing other things with it. But is that always the case?
So there could be cases where there is a bad bookkeeper that that is in charge of the payroll function, and the owner has no idea that this is happening. It could be the case for sure. But the problem there is that the trust fund penalty is assessed by the IRS, and I'll explain that in baby steps in a second. Not only on the owner, but a person who has oversight of the payroll function. And let's say this payroll function is not working, that there is payroll tax theft. So what does this trust fund penalty mean? That means that now you, the owner, the bookkeeper that is running payroll, and this is not being done right, and the money doesn't go to the government, they are personally could be held personally liable for the payroll tax. So the bookkeeper is not the owner.
Yeah.
But could they be personally personally accountable for payroll tax? Yes.
Because they're the ones that are keeping
they're
the books.
the ones. Yeah.
Interesting.
So it's like, you think of it like, why do you form an LLC? You form an LLC so you as a person is protected from corporate veil being pierced, right? So they stop at the LLC level. Okay, with payroll tax, it doesn't stop at the business level. They pierce through to the person.
Gotcha.
Not just one, but whoever is responsible.
Gotcha. Now you mentioned you were going to explain trust fund penalties a little bit more. So what exactly are those penalties?
So for example, in my example, let's say this business is behind, and let's say the business is behind, and the payroll tax that they collected from people is $200,000.
Right.
Okay. Payroll tax is also comprised of what the business has to match. So it's 7.5. So the business has to match. So that's not trust fund. Okay. The trust fund is what came from the people, from the employees, in simplified terms. Okay. So let's say in my example, it's $200,000 that the business owes. So $200,000 now is personal liability from the IRS standpoint with regard to the owner.
Wow.
So if you pull the transcript of the owner, you see this $200,000. So it's
Wow.
serious. Yeah.
So then what could that person be facing? Is it just essentially now you have to repay this? Are there criminal implications?
Yeah.
What kinds of
It
penalties?
gets, it definitely gets as serious as criminal, but because it's, like I said, it's theft of tax. But ultimately, people do want to work it out. Things happen, there are mistakes made and all that. But people would want to work it out with the revenue officer and show good faith effort and comply and get themselves on installment plan, whatever those resolution options are available case by case to people. But this is serious stuff.
Interesting. So then for the business owners out there, or maybe even the bookkeepers who are responsible for managing these kinds of things, do you have any tips for them out there to, make sure that they do not end up in a situation where they're mishandling it and now they have this potential, theft of tax situation on behind them? Is there something they should be doing throughout the year with their payroll that you've seen is, maybe best practices that could help them?
Yeah, so for the business owner, it would be you cannot look away and say, "Oh, my bookkeeper is doing it," but there is something going on. There are red flags.
Bury your head in the sand.
But I don't know because I'm not an accountant. I don't understand tax. No, that's not going to fly.
Okay. Ignorance of the law is not a defense.
So you're the business owner. You need to dive in and see what's going on. IRS has good tools now where you can create an online account, business or individual, and you can. There is a way to track your federal tax deposits with regard to payroll. Another tip would be, use good, trusted payroll company. Why are you doing this function yourself? It's not that expensive. It's not like crazy expensive. But once again, you're ultimately the responsible party here.
Right.
And if it's a bookkeeper and you see that something is going on, there is I don't know any other way other than obviously understand that you're going to be liable.
Yeah, because of the personal liability risk that you're talking about. Yeah, it does make sense to just give it to the professionals. Let someone who's skilled in this process handle it for you. And there's, like you said, there's so many companies out there that they just know how to handle it correctly, and so that you don't have this big tax penalty out there or implications of theft. Obviously, I would imagine that there's pretty serious criminal charges or exposure that can come along with that.
And to parallel that with Florida, because we were talking IRS, federal side, but to parallel that with Florida, like I said, there is Florida sales tax that businesses have to collect. It's not their tax. It's the tax that they collect from customers.
Sure. Yeah.
Like a restaurant collects tax from sales of food and stuff. So what they're doing is they could be misusing that sales tax. Keeping it and misusing, and not sending it to Florida. Similar concept, obviously different. Those are two different jurisdictions, federal and state. However, ultimately, it is also theft of tax because you're collecting somebody else's money that's supposed to go to the government and you're not sending it to the government. So what is it? Theft of tax. And there are also criminal penalties, exposure, and civil penalties and all that. So it's very serious.
For this kind of thing, I know with, individual taxes, sometimes they're more willing to work with you. There can be payment plans, different things that are worked out. Is it handled similarly with this, or are they less likely to negotiate with theft of payroll?
Yeah, you do want to, first of all, comply in good faith. So they're going to request a lot of financial information from you to see what you're spending your money on. So, but ultimately, you do have resolution options. It's not like you're completely done and you're going to go to jail tomorrow. No, but you need
that's good to know.
Unless it's something
they don't come
crazy.
Your way right away.
Yeah, it's not, maybe, hopefully it's not something crazy. But ultimately, the ones that want to work it out, they run to the tax lawyer typically. They hire a tax lawyer and the lawyer tries to work it out just so, and there are installment plan options. There are resolution options for people like that. The enforcement efforts are definitely aggressive. Yeah.
What do you mean by that? What kinds of efforts do they take?
They can have. So one of it is freezing bank accounts. So if you're a business and your account is frozen, how are you going to do business?
Right.
How are you going to generate revenue? Right. So that's an inconvenience, to say the least.
To say the least, yeah.
So that's one of it. But there are all sorts of other things like liens. Levies.
Yeah. Again, that's something that you just don't want to be on the bad side of the IRS when it comes to that. So I appreciate that tip. And of course, if you are a business owner out there and you're unsure about how your payroll taxes are being handled, this is a show that you want to keep listening to. If you have a question, the lines are open. Feel free to give us a call or drop us a comment. The number is 727-441-3000. We are still in the middle of our tax law show tonight. It's a good time to take a short commercial break. But when we come back, we still have much, much more with attorney Alena Miles, who's talking about tax law tonight, of course, Florida tax law. And we will be back with her after the break, answering your questions and discussing more about this. We'll be back after this commercial.
This is the Tan Talk Radio Network.
After a car accident, there are many questions that you need answers to. Who pays for my car repairs? Who pays for the medical bills? What about my lost wages? And more. The personal injury law firm of Pernick, Caulfield, Averill & Noyes has been answering these questions for their clients for nearly 70 years. Since 1955, they've been a voice of the injured in the legal system. As one of the longest established law firms in Tampa Bay, Pernick, Caulfield, Averill & Noyes is here to answer your questions. Listen to their live call-in radio show on this channel every Tuesday evening from 5 to 6 p.m. or call them at 727-796-8282 or visit them at voiceoftheinjured.com. Offices Clearwater, non-attorney spokesperson.
This is the Tan Talk Radio Network.
And we are back with FLALAW live on the radio. Thank you so much for joining us once again. With FLALAW on the radio, again, this is your live legal call-in talk show. We come into you every Tuesday at 5. Hopefully you've been enjoying the show. We do have attorney Alena Miles with us, who is a tax attorney and also a CPA. And we have been going over Florida tax law tonight, giving you some tips for your recent tax filing, deadlines that might be coming up, COVID era abatements that could be available to you for refunds and reimbursement for penalties and interest. So you have some great topics that have already been discussed. If you missed it, that's okay. I want to plug our podcast because that's a way for you to go back and listen to what you missed on the live show. We do have a podcast that is on Spotify, Apple Podcasts, iTunes, iHeartRadio, wherever you pretty much can find podcasts. You can find FLALAW on the radio there as well. So if you missed the beginning of the show and some of the tips and things that Alena Miles was telling you about, the Kwong case and different things that may apply to your situation, especially if you're a business owner, then go over and find the podcast. It will be posted soon with the broadcast from tonight. So just search FLALAW on the radio. You'll find our podcast. We're one of the #1 personal injury podcasts there. So it shouldn't be hard to find. Just follow us, and then you'll always get the updates whenever there's a new show. With that being said, let's jump back into our tax discussion for tonight. We know that there was recently the bill that was signed by President Trump, the big and beautiful bill. And so there were some tax cuts that came with that. So I think there might be some tax savings that, came out of that legislation. So I want to talk to you a little bit about that and see, did anybody, maybe miss some tax savings? So I want to talk about the Trump tax cuts and also the Jobs Act. Now that people have already filed, what do you think they might have missed? Because what are some of the most common, missed opportunities that you see?
Yes. So basically, Big and Beautiful was signed into law in July 2025.
Mm-hmm.
Okay. So I think there are pretty good provisions there for small business owners as well as individual taxpayer. Maybe the refunds and all that are not as big as people hoped.
Okay.
But also you don't want to miss stuff that is available to you. So I'm just going to name a few just so people, just to give you food for thought.
Yeah.
Okay. So in terms of the businesses, bonus depreciation is huge. So bonus depreciation is a write-off. It's a write-off that decreases your income, that lowers your taxes, okay? And it's an immediate write-off of eligible assets that the business have placed in service. So it's not anything, it's eligible assets, okay? What can it be? It could be the vehicle that the business purchased.
Okay.
Okay. It could be the machinery and equipment, okay? Fixed assets, furniture, that kind of stuff. But when we talk in real estate, those could be huge dollars, okay? If you have rental real estate or if you have commercial real estate, what people can do is a strategy called cost segregation study, okay?
Let's break that down.
Yeah, so that's a strategy. That's something that they would have to hire third-party professionals who do cost seg study work. And what they do is they basically provide, ultimately the work product is the report that they provide, where they categorize the assets in a couple of buckets, okay? And one of the buckets is that bucket that is eligible for bonus, or in other words, immediate write-off. So that's where the meat and potatoes of the cost seg strategy is, okay? So once they determine that this is that bucket of eligible assets, you can write them off in the year when you placed it in service.
Okay.
So for a huge commercial building, this could be huge, right? If you do not do cost seg study, let's say commercial building is depreciated over 39 years, the 39-year life.
Yeah.
So you can't just take and write it off. You cannot do that. Land is not depreciable. You have to allocate some piece of the purchasing price to land. But how much do you allocate? So they will break it down for you into those buckets of assets. And ultimately what you're looking for is that bonus eligible bucket of assets, which you can use to write off, or in other words, immediately decrease your taxable income if you placed it in service in that year.
Okay. Now that's businesses. Are there any deductions or strategies that individuals, might have overlooked, especially given, the Big and Beautiful bill?
Yep. So the bigger one for regular people, I shall say, is no tax on tips.
Right.
Yeah. So Jaclyn, if let's say we have an adult entertainer.
Okay. Let's keep
who
it
is
spicy.
self-employed, and the adult entertainer collects tips.
Yeah,
that's all she collects. Is tips. Let's make it.
Yeah, we're going to be equitable here.
Yes,
or
let's make it hit. Yeah. And so, okay, so certain amount of tips, not everything, but certain amount of tips in that example, even if the person is self-employed, okay, is perhaps it potentially is not going to be subject to income tax. Now, payroll tax and income tax are two separate tax.
Right.
So that amount is still going to be subject to payroll tax or self-employment tax if it's a self-employment person.
Okay.
But we're talking income tax.
Yeah.
So Big and Beautiful helps with income tax.
Right.
So that's the perk that people might overlook. Same idea was overtime. And there are other things.
And remind me again what Big and Beautiful did for overtime. There was no...
Yeah, there was some exemption amount, so much money you can exempt from income tax.
From that, okay.
But once again, income tax and payroll tax are two separate tax.
Right.
So it would still be most likely than not subject to payroll tax, but some amount is going to be exempt from income tax. Now, for some people, it could be bigger number, but just... I guess if you missed that, you can go back and amend your tax return once you have that information.
Okay.
Yeah.
But I heard you say in the beginning that the refunds weren't as high as some people might have been hoping. Is that what you've been seeing?
I think that's
there was a higher expectation.
I think the expectation was higher. Yeah. Mm-hmm. I think there are good provisions and big and beautiful for businesses who can take advantage of, like, and I'm going to name some complicated things, but it's 1202 and opportunity zones and stuff like that. More like bigger investors, where they can defer more income.
Right.
So those were, heavy hitters. People can write off interest on car loan, interest on car loan, okay, if it's a personal car. But it's so limited in terms of how much interest you can write off, potentially, because the car has to be assembled in the U.S. You have to put the VIN number on the form. You have to be the first use, meaning first owner of the car. So there are all sorts of restrictions that you have to go through steps to figure out whether you can even take advantage of it. Now, it's,
So for anybody that's listening to you right now and they're thinking, I may have left some money on the table with my filing that I just did, is it too late to fix those mistakes after they file?
No, it's not too late, because we're within that, even if it's 3 years to get the refund, we're within, because the return, let's say, was filed, but it was filed just recently.
Sure.
So we're within that time frame. But once again, the 3-year rule is more complex. It's just simplified. But no, you can always, if it's small, if it's somebody who cannot afford to go to a tax lawyer, it could be a case too. Just ask your CPA or accountant to double check the numbers to make sure. Raise those points. Say, hey, I just want to make sure I didn't miss. No tax on tips, and let them explain it to you.
Right.
I think you do want to give the chance to whoever did your taxes, assuming it's a reasonable person, to answer your questions before you start spending money on a tax attorney in that case.
Sure.
But it could, so if it's a smaller number, if it's a bigger number, like you're talking big, heavy strategies, you do want to have somebody to look at it thoroughly.
So in your experience and things that you've seen, who do you feel are most likely to be leaving money on the table? Is it W-2 employees or business owners, a mixture? What do you find that people are just leaving money out there?
Technically, it could be anybody, because smaller refund in our eyes could be big money to somebody, some person. Or bonus depreciation, even though it's an immediate write-off, it's not like a loss deduction, because if they used if they used more gradual depreciation, in other words, they didn't take write-off right away, they're still gonna take it throughout the year. So it's like timing when you write it off. So it's not like they completely didn't use it and lost it. Okay. There are all sorts of mistakes, all sorts of cases where people could have some, you just made me think about another thing is pig butchering. A lot of people get scammed right now. A lot of people get scammed and they lose money, and they can potentially recover, not recover the money, that's not the right way to say it, but they can potentially claim a deduction if it's a pig butchering theft deduction on the tax return, not any tax return.
Did you say pig?
It's called pig butchering theft scheme.
What is that?
So it's basically, in a nutshell, it's basically,
I imagine it's not literal.
A lot of people come with those questions. This is this is actually happening right now to a lot of people. They have some scammers find you and they tell you to invest money in for profit. So it has to be for profit. It cannot be like a dating scam.
Yeah.
If it's a dating scam, it's not going to
a foreign prince that get
Foreign
you to send them
prince-
money. That's not going to work. Yeah. Okay.
No.
Okay.
But if they say, okay, so look, you invest and they build trust with you and you invest for money and you can prove that you invest for money,
Mhm.
and then money is gone and you cleared your IRA account or your pension, whatever, and now you're out of money.
And you have penalties and things like that.
Yep.
Yeah.
And you have that early penalty
Yeah.
and all that, in addition to income tax and all that. So you can amend your tax return, but you have to know which tax return to amend. So once again, it's not as simplified as I'm explaining, but you can potentially claim the theft loss deduction.
Interesting.
And it's called pig butchering theft scheme. It has to meet the criteria for that scenario.
Do you have any idea why they call it pig butchering?
I
That's
don't know.
an interesting phrase.
I'm just,
Wow.
yeah. It's,
Okay.
I guess, like the Ponzi scheme scenario.
Yeah.
I think that one could be eligible as well. Like romantic one, the dating one is
They
not.
don't, yeah.
But the pig butcher, I guess it's because like they're trying to get a lot of pigs to butcher.
They're herding them in. Yeah.
Mhm.
Interesting. So then what is the process? So obviously I know you said before, written letters aren't necessarily going to go very far. So this is like a formal amendment that you're amending of your return, or how does that work?
So first you have to, like, I would like if you came to me with the pig butchering scam scenario and said, look, I lost money, they stole my money. The Western criteria I would have to troubleshoot and go through to figure out if it meets into that pig butchering scheme. If it does, then the next step would be to identify the correct tax year to amend, because it could be tricky there too. And then we amend.
Okay, and that's the same for any situation where you may have left money on the table or there's opportunity. You just have to go back and amend in the correct year.
Exactly, right. But once again, I don't know if I said it before, but amended tax return is at discretion of the IRS. In other words, they can say no to you. If you amend, they might say no.
Yeah.
Typically, it doesn't happen like that, but ultimately, they have discretion.
Yeah. So it sounds like just because you filed doesn't mean you optimized in, the way you filed. So it's always very important to make sure you have the right tax professionals or tax attorneys in your corner when you're filing, because you may have missed quite a bit of opportunities if you're not doing it correctly. When it comes to that, then if people are looking ahead to next year, is there anything that they should really be thinking about or planning for now?
Yeah, so one thing they could think about is estimated tax payments, because, and we're on the tax show.
This is the same.
So taxes. But the Q1 2026. Now we're talking tax year 2026.
Right.
The Q1 was due April 15th. Then you have June 15th, I think September 15th, and so on. So in other words, if you're a business, let's say a self-employed business, and you're earning your money, but you're not paying your income tax, the IRS wants like little deposits from you. It has to be calculated, and they don't want to wait until April 15th of 2027 to get your 2026 tax in.
I see.
They want deposits calculated and paid upfront like that. Now, if you do not do that, if you, let's say, okay, I'm just going to wait until April 15th, 2027 to pay my 2026 tax, you're going to have underpayment penalty.
Gotcha. Gotcha. So those are things you definitely want to be thinking about now.
Yes.
Yeah.
In addition to Kwan case, July 10th.
Yes. Kwan. Don't forget the Kwan case. Your deadline is July 10th for those COVID era tax abatements. Now, so in our last few minutes, I do want to talk about FIRPTA, which is kind of some real estate deals with hidden tax traps. And the reason why I want to talk about that, because next week's show, we have a real estate attorney coming on the show. So I think this is a good segue for next week. So let's talk about real estate. What is FIRPTA and why does it surprise people?
FIRPTA applies when seller of U.S. real property, a house in Safety Harbor, is foreign. So let's pick on a country. Which country do we pick today?
Oh gosh, where I forgot where you're from.
Belarus.
I was going to say, where are you from again? Belarus.
So Belarusian person owns a house in Safety Harbor. Okay, but Belarusian person is not a U.S. citizen, not a U.S. resident, has nothing to do with U.S. other than just let's say sometimes comes here on a visa,
Mhm.
okay? And they have a house here and they're trying to sell it. Okay, so the FIRPTA is going to apply because in my example, the seller is a foreign person. Now, who the buyer is doesn't matter. But the trick about FIRPTA is that buyer has personal liability to withhold money from seller. So if buyer misses this point, buyer is ultimately responsible before the IRS, even though it's kind of seller's problem.
Why? Why does it shift to the buyer?
Because how are they going to catch the Belarusian person who
doesn't live here?
runs to
Yeah.
Belarus now? They get the money, they sell, and they're gone.
That
so
is the
how are they
risk.
going to catch you?
Yeah. So I mean, that has to be savvy realtors and helping their buyers to
Mhm.
understand that and making sure
On
the
the buyer.
deal is very clean for the buyer. Yeah.
And it's 15% not of your bottom line. It's
Mhm.
15% of the gross selling
sale
price.
price,
It could
yeah.
be huge.
That's a big amount. Wow.
Mhm.
Interesting.
But that could be like something to negotiate too. Like if you have a FIRPTA
Mhm,
situation, if you
mhm.
know that your seller is foreign, negotiate because that's not an easy transaction. There are more costs there.
Yeah. So what happens if you get all the way up to closing and this has been missed? How do you deal with that?
Penalties. So once that gets discovered, there are penalties. There are all sorts of mistakes that can be made. I've seen mistakes where, okay, so the seller could have applied for exemption, but
Mhm.
what if 3 years later exemption is denied? Buyer is penalties are huge for buyer.
3 years later?
3 years later, because it takes the IRS so long to, let's
Oh,
say,
my goodness.
process the exemption, process it all through.
Yeah.
And boosh, you get like a big penalty notice as a buyer.
Yeah.
And you're upset because, wow, this is unexpected.
Yeah. So then from a tax attorney perspective, if you're, considering a purchase like this and you know that your seller is a foreign seller, what can you do to protect yourself in those kinds of situations? You just back out and say, you know what? I don't want to do this deal, but there has to be some way to protect yourself, right?
So first of all, let me backtrack a second. If you already too late, you can come to me for penalty abatement opportunities.
Okay. All right.
So I can try to abate those penalties.
Okay.
There
Good
has
to
to be
know.
reasons and all that, but it's not the end of the world.
Yeah.
It's potentially can be a bit. But for to answer your question, like pre-planning side, yeah, you do want to come to me 90 days in advance and make sure that we go through the facts and nothing is missed because, mistakes happen.
Yeah. So then there's ways that you can kind of do the buyer seller contract agreement that could help address some of those.
Yeah, so I
issues,
could either represent the buyer or I could represent the seller, because if seller is has that money withheld, they can potentially get the refund later.
Yeah.
So they can come to me for that too.
Yikes. So guys, you could close on a property and still have some tax issues following you afterwards. So that's very, very, very good information to be thinking about if you're in the market to be buying right now and the seller is a foreign seller. Great advice. We are now at the end of our show. Thank you so much, Alena Miles, for joining us once again. She is always an excellent source of knowledge for all things Florida tax law. At this juncture, I just want you to obviously give an opportunity just to tell people how they can find you, where they can call you if they have follow-up questions.
Thank you, Jaclyn. Yes, my phone number is 727-977-8270. My name is Alena Miles. The name of my law practice is Attorney Legal PA, www.taxattorneylegal.com. Thank you.
Wonderful. And that has been FLA Law live on the radio. We are the personal injury attorneys of Pernick, Caulfield, Averill, and Noyes. And we will see you next Tuesday at 5. As I mentioned before, we'll have real estate attorney McKinley Justin with us to talk all things Florida real estate. Folks, we will see you next Tuesday at 5 o'clock with FLA Law on the radio.